Welcome to the Deep Dive. Now, if your work takes you across the Asia-Pacific region, you definitely know how vital it is to find, well, a solid, compliant, and frankly comfortable place for those longer stays. We're talking about the solutions many of you rely on: professionals, entrepreneurs, corporate teams. Things like good service departments, efficient serviced offices. The setup you need when a trip isn't just days, but weeks or even months. Today, our mission is to cut through some serious complexity. There's a major policy shift happening in Thailand, a huge APAC hub. Okay, let's unpack this because what Thailand's doing isn't just tweaking the rules, they seem to be fundamentally tightening their fiscal policy. And that impacts pretty much every long-term business traveler and expat there.
It really does. You framed it perfectly. This isn't just some minor local tax adjustment. It feels more like a profound reinterpretation of existing tax rules.
Right.
And it signals something bigger happening globally. We're seeing governments, especially in APAC, really stepping up scrutiny on cross-border money flows, trying to maximize revenue. So yeah, for anyone who saw Thailand as maybe a softer touch for foreign earnings, whether you're a foreign resident or even a Thai national coming back, the game has changed, like right now.
Okay, let's dive right into the core issue then, because this is the big one, the revelation that's really shaken the expat community, right? Thailand used to have this, well, strategic advantage for handling income earned overseas. The rule before was pretty clear. Income earned abroad was only taxed by Thailand if you brought it into the country in the same year you actually earned it, which, let's be honest, created a bit of a loophole for careful financial planning.
That loophole, it's gone. Dead. Completely. The new reality, and this kicked in January 2024, it just changes the whole timeline. Now, basically, all assessable income you transfer into Thailand is potentially subject to tax. Full stop. It doesn't matter when you earned it.
Whoa, hang on. Let me make sure I'm getting this and that our listeners understand the sheer gravity of that. So say I was, I don't know, a marketing exec working in Singapore 5 years back. I earned a salary, put it in my account back home, say in the U.S. Now, mid-2024, I transfer some of those savings into my Thai bank account to pay for a 6-month lease on a service department in Bangkok. You're saying that 5-year-old income earned long before this rule change is now potentially assessable for Thai tax.
That is precisely the new interpretation, yes. The change isn't just looking forward. It applies to any foreign income transfer in 2024 or later, no matter the source year. This is absolutely critical for professionals, maybe retirees too, anyone drawing significant income from foreign investments or, like you said, past salaries. The one thing that stays the same is income earned inside Thailand that's always been taxable, regardless of how long you're there. But for those relying on foreign money, the planning just got way, way more complicated.
Okay, and here's where it gets really interesting, especially for, say, the corporate clients or business travelers using those long-term stay solutions we mentioned. Before, figuring out who was an expat or resident for tax, it could be messy, right?
Yeah.
Tied up with visas, work permits, what's the new yardstick? How does Thailand define who owes tax now?
They've gone for a much blunter instrument, really. It's all about physical presence, that old complexity. It's basically boiled down to the 180-day rule. Simple as this. If you spend 180 days or more inside Thailand within 1 calendar year, boom, you're considered a tax resident. Your visa, tourist, business, smart visa, whatever, it's largely irrelevant for this specific determination of tax residency.
Just based on days physically in the country.
Exactly. And what's fascinating here is how this forces, well, incredibly meticulous compliance. Think about that corporate traveler using flexible places like service departments or even serviced offices, their travel calendar. It needs tracking with almost military precision now. That 180-day mark is the absolute line in the sand. Cross it, and you've triggered tax residency, and with it, all the obligations for any foreign income you bring in during that year.
Wow, that sounds like a huge compliance headache. When you say meticulous record keeping, what are we actually talking about? What will the Thai Revenue Department look for? I mean, beyond just an immigration stamp and a passport.
Yeah, that's the practical challenge, isn't it? The stamp is primary, sure. But the Thai Revenue Department, like tax authorities globally, looks for evidence of, intent to reside or just significant presence. Things like utility bills, local bank activity, maybe those long-term rental contracts for service departments or offices you mentioned, even frequent credit card use inside Thailand. So compliance means keeping super detailed financial records, all your income sources, all transfers, and potentially being able to prove where you were day by day. It's a big ask.
Okay, given how big a shift this is there any relief? You mentioned a grandfathering clause earlier. Is that enough to, say, stop people from leaving. Tell us about that exemption again.
Right. There is one major exemption. It gives some breathing room, but it's quite specific. Any savings or funds you accumulated in foreign accounts before December 31st, 2023 are exempt, even if you transfer them into Thailand now in 2024 or later. It's essentially a grandfathering clause. It aims to protect past savings that were legitimately earned and held offshore under the old rules.
Okay, so past savings are safe.
The savings are safe from the new tax rule, yes. But the challenge shifts, doesn't it? It shifts from taxation to proof. The burden is entirely on you, the taxpayer, to prove with documents that the money you're transferring actually originated before that December 31st, 2023 cutoff. If you're moving significant amounts, proving the exact origin, the accumulation date, that's probably the new major compliance hurdle right there.
Right. So for the many long-term residents, maybe retirees, people who'd really planned their finances around the old system, this is a serious rethink. If you're using a nice serviced apartment in Bangkok as your regional base for, say, 10 months a year, how does this fundamentally shake up Thailand's appeal?
It totally changes the cost calculation. Thailand's always been attractive, partly because of its cost of living, sure, but also because of that relatively relaxed tax treatment of foreign income historically. Now, if you hit that 180-day threshold and become a tax resident, your effective tax burden on that foreign income could jump massively compared to before. So yes, long-term residents, retirees, they are actively crunching the numbers right now, asking if they can still afford to stay.
Yeah.
It definitely dampens Thailand's competitive edge for those really extended year-round type stays.
And if the calculation changes for one big hub, someone else usually benefits, right? We could see people, maybe executives or long-term consultants, deliberately managing their stays now, keeping them under 180 days, maybe opting for more flexible travel packages that keep them moving around the region more.
Absolutely. That's a likely market shift, we'll see. You know, the convenience of a serviced apartment for, say, 150 days, still high. But committing to a full year, or even just over 6 months, that now carries a significant tax risk it didn't have before. And it raises the obvious question, which neighbors might benefit? Countries like Malaysia or Vietnam seem like prime candidates. They often have competitive options for accommodation and might suddenly look a lot more attractive to expats, digital nomads, whoever is really prioritizing tax efficiency in the region. The competition for that mobile, high-value individual, it's definitely heating up.
Okay, but let's shift gears a bit because there's another side to this coin, is there? The Thai strategy isn't just about the stick, finding more tax revenue. There's also a carrot involved. It seems like while they're closing loopholes for some, they're also trying to actively attract a different group back into the country. It's like a dual strategy.
That's the crucial context, exactly. It's not just a revenue grab from current residents. Thailand clearly recognizes it needs high-value talent. And interestingly, it's putting a big focus on getting its own skilled citizens back, people who left for opportunities elsewhere. So yeah, they've rolled out a very specific, quite sophisticated program to lure skilled Thai expats home.
Tell us more about those specifics, because just saying incentives doesn't quite capture it. What's on offer?
The offer is pretty huge, actually. To qualify, a returning Thai national needs a bachelor's degree minimum and at least 2 years of work experience outside Thailand. If they meet that, the benefit is massive. A fixed 17% income tax rate. Now, you have to remember, Thailand's standard income tax is progressive. It can go up to 35% for top earners, so a flat 17%. That's an enormous, potentially life-changing tax cut for high-income professionals.
Wow, 17% flat rate. That's aggressive.
It is. And there's more. The incentive extends to the companies that hire these returning Thais. It encourages firms to participate in this national brain gain initiative, as it were. Employers in specific target sectors get a really generous benefit, too. A 50% tax exemption on the salary costs for these returning workers. And this isn't a short-term thing. The program is set to run all the way until December 31st, 2029. Shows real commitment.
And it's not just any returning professional, right? This sounds highly targeted.
Oh, completely targeted. They are focusing the investment squarely on sectors they see as crucial for Thailand's future economic growth. We're talking technology, advanced manufacturing, R&D, that sort of thing. So by using tax policy to effectively subsidize salaries and slash the personal tax burden for this very specific group, Thailand is basically making a big bet, investing heavily in boosting its high-value economic sectors and tech advancement. It's quite strategic, really.
Okay, so wrapping this up, what does this all boil down to for you, the listener, the professional, the corporate team trying to navigate extended stays in APAC? It sounds like the era of maybe easy or assumed tax breaks is kind of over, replaced by hard data, tracking, compliance.
Your financial strategy just has to adapt now. If you're using those convenient serviced offices or apartments for long stretches, you absolutely must treat that 180-day rule as a hard line, non-negotiable. If you cross it, you need to fully understand you are a Thai tax resident now, and your whole cross-border financial picture is potentially under scrutiny.
Which means getting professional advice from qualified Thai accountants, maybe lawyers, is not really optional anymore, is it? It sounds essential to make sure you're compliant, both with the residency definition and these new rules about transferred foreign income. Definitely not a DIY situation if you're staying long-term.
Couldn't agree more. And look, Thailand's move, it's probably just a leading indicator. It points to a global trend. The real takeaway here might be that easy tax environments for international earnings, they're becoming a thing of the past, pretty much everywhere. Governments are getting smarter, closing loopholes, and using physical presence, something much easier to track now, to ensure they capture revenue.
Okay, so here's the final, maybe provocative thought for you to chew on as you plan that next long business trip or assignment. If this definition of tax residency, that simple, stark 180-day physical presence test, becomes the strict global standard, how fundamentally does that change the whole idea of digital nomadism? Or that sort of borderless life many professionals aspire to, the digital breadcrumbs, the physical data trail we all leave, phone location, leases on those service departments. It's making the borderless life fiscally very, very traceable. You might gain flexibility in where you work, perhaps, but are you losing the flexibility in how you're taxed? Something to definitely think about as you decide whether your next APAC stay crosses that critical 6-month threshold.